Gulf disaster can only drive the price of crude oil higher. But at the same time, look at the prices of the companies involved in the spill, like BP and Transocean. As Sean just showed you, those shares were cut in half in just a few weeks. And you're seeing those declines reflected in most energy ETFs. One of the most popular energy funds is the Spider Select Energy ETF, ticker symbol XLE. At one point, it dropped more than 18% as a result of the oil spill. More specialized funds fell even faster. So really, buying shares in any company involved in offshore drilling is a risky play right now.
Ron, though, a lot of experts think that what hurts oil companies will only help natural gas and other alternative sources of energy.
I agree. And ETFs offer a lot of options for investing in natural gas and other energy sources. One way is through a fund that invests in natural gas futures contracts, much like the oil fund we discussed earlier. There's also ETFs that invest in individual companies. An example is a First Trust ISE Revere Natural Gas Index Fund, ticker symbol FCG. But there's literally dozens of energy ETFs, including those that focus on solar, wind, and even nuclear energy. Investors just need to figure out which commodities they want to buy, what kind of exposure they want, and then find the fund that best suits their needs.
All right, Ron Rowland from the Lone Star State. Thanks so much, Ron. Volatility. It is a big part of playing the commodities markets, and long-term investors may have a much different strategy than those looking to make a quick profit. Our next guest thinks that's a wise thing to remember when you're investing in natural resources. Klaus Vogt is the editor of the German edition of the Safe Money Report. He joins us from Berlin. Klaus, do you agree that commodity prices are on their way up?
Yes, Jamie, I am, but only over the long term. Commodities prices are right in the middle of a secular bull market, and in general, they've been rising for the past decade, and 5 or 10 years from now, they will be much higher. But in the short term, I'm seeing some very bearish signs for natural resources.
Such as what? Well,
I don't have to look any further than right here in Europe. The sovereign debt crisis is a clear sign that the economy is in trouble, and the UK, Japan and the United States have a lot of the same underlying problems, such as too much debt and deficit spending. The reason that's bad for commodities prices is that historically they move in lockstep with the economy and the stock market.
Klaus, though, if you look at the U.S. stock market, it's been up and down a bit recently, but still relatively strong.
Yeah, and I think that's going to change. I expect a bear market for stocks to start in August at the latest, if it has not already begun. The reason for that is waning liquidity and what Alan Greenspan called irrational exuberance. Mutual funds are pouring money into the stock market. The cash level of investors reached a new record low of 3.4% according to ICI, and you can see that low levels of cash correlate with highs in the stock market. So mutual funds are important. When mutual fund managers hold so little of their assets in cash, it means they have little buying power and little flexibility. And in the past, that has always been followed by a correction or a bear market.
Okay, so you expect commodity prices to follow?
Yes, and I think the top in the stock market will coincide with a top in most commodities prices as well, including crude oil. We may have already seen the top in some industrial metals such as copper.
So based on cyclical indicators, Klaus, you think we're headed into a bear market for stocks and commodities, including oil. But what about the argument that oil production has hit its peak? Wouldn't a drop in supply lead to increased demand and higher prices?
You know, in the medium to long term, I think that's true, yes. Those factors will play into the secular bull market theme that I mentioned earlier. But right now, I'm focusing on the cyclical indicators, and they tell me that this business cycle is ending, and that means a drop in commodities prices in the short term.
Okay, Klaus Vogt from Berlin, thank you so much for joining us.
Thank you.
So we've heard about the relationship between commodities and the stock market, But how do currencies play into that equation? Well, here to answer that question now is Weiss research currency expert Brian Rich. Brian, normally the dollar and commodities move in opposite directions, but we haven't been seeing that recently. What's going on?
Jamie, most commodities are priced in dollars, so as commodities move up, the dollar tends to move lower and vice versa. But as you said, that hasn't been the case recently, especially when it comes to gold. We've seen a sovereign debt crisis sweeping Europe and threatening to expand, and during this crisis period, investors are looking for safe havens. So the recent gains in both gold and the dollar are driven by fear.
Okay, but couldn't the sovereign debt crisis eventually threaten the dollar as well? I mean, we have many of the same economic problems that places like Greece and Portugal do.
That's true, but economies all over the world are struggling. So among paper currencies, the dollar is still considered a safe investment. Despite its problems, the U.S. still has the deepest, most liquid capital markets, and investors looking for safety will always want to align themselves with the largest economy in the world.
Okay, do you see these trends continuing?
It seems clear that the sovereign debt crisis isn't going away anytime soon. So the dollar and gold will continue to have a safe haven appeal for investors that are looking to protect their money. But it's a different story for most other commodities. As Klaus told you, commodities have a strong direct relationship with economic health. If the global economy goes into another recession, which I think is a possibility, global demand will decline. And in that case, crude oil prices will likely come down along with most agricultural commodities and other metals. And that, in turn, will hurt other countries and other currencies, specifically those commodity-centric economies like Australia and New Zealand and Canada.
If there are more economic problems ahead, how should investors be playing the currency market then?
Well, it depends on how aggressive you want to get. I think the euro and the British pound still have a long way to go to the downside, and the euro could collapse entirely. So you may want to short those currencies. But I think the prudent play in a time of crisis is to think about return of capital rather than return on capital. And the best way to do that is to continue to seek proven safe havens like the dollar and gold.
Okay, Brian Rich, the man born to be a currency expert. Thank you so much for joining us.
Thank you.
One thing has always been true of the commodities markets: they're volatile. Investors looking for short-term gains have to weigh several factors: the global economy, geopolitics, interest rate policy, the stock and currency markets, and even then, you still have a large measure of uncertainty. It seems a good bet that gold will continue to rise, and we'll be talking more about that in future episodes. But what about oil? In the short term, we've heard opinions on both sides of the fence, but the long-term trend seems clear. There will be increased demand from emerging economies, dwindling supplies, and higher prices. How we deal with those rising costs will be a matter of much debate in Washington, and our economic future may be riding on the answers. I'm Jamie Holmes, and now, Martin Weiss.
Most officials and investors focus on the Gulf oil spill as a short-term disaster, and no one can deny that it is having a monumental short-term impact. But now it's time to connect the dots more broadly. In this program, you've seen the impact on deep-sea oil exploration, on global energy supplies, and on the likely trends in energy prices. Plus, we've told you about investment strategies to capitalize on those trends. But let me remind you about one more connection: the connection between money and energy. Money represents what politicians control, the paper that the Federal Reserve can print and pump into the economy seemingly at will to artificially stimulate demand, to push growth at almost any cost. Energy, on the other hand, represents the finite resources that politicians cannot control. Yes, they can create more money, but they cannot create more energy. And when those two forces collide, the consequences can be catastrophic. The Gulf oil spill disaster is a classic example of what happens when the Fed pushes up demand for energy faster than it can be supplied. And next week, we'll give you another shocking example of the consequences of a central bank run amok. I'm Martin Weiss. Thank you.